The market's shocked by much higher than expected inflation numbers. Hi, everyone, and welcome to Ainsley Insights, brought to you by Ainsley Bullion, Ainsley Crypto, and the Gold and Silver Standard, as the Ainsley Group celebrates 50 years. Today, we welcome back Branko, who's been completing a deep dive into the higher than expected inflation numbers out of the US. That came in last night or early this morning for us, where we were starting to look at that. How are you going today, Branko?
Good. Keen to talk about today's topic. I think there's a big surprise, kind of shocked markets, and people don't quite know what to do. So keen to dig into it.
Yeah, and you and I were just sort of discussing before this. We've got sort of mixed opinions between us on what's actually going on here and why, but we'll dig into that a little bit later. Let's start off with what did the inflation report actually reveal, and why was it such a surprise to everyone?
Yeah. So basically, a lot of it was driven by increased like fuel prices, rent prices, things like that we probably should have expected. But overall, core inflation came in at 3.8% when the projection was 3.7, and then more importantly, consumer prices rose about 0.4% for the month, 3.5% over the year, which were both above expectation. So at the end of the day, all the numbers came in above expectation, and the markets really kind of tanked off that because as we kind of discussed a lot, it's been expected that rates will get lowered, and when inflation data spikes up, that makes it less likely.
And that reaction is interesting because, as you said, we sort of had that dip, but some of those markets have stabilized a little bit since. Uh, what's your take on the market reaction generally? Was that you see a lot of headlines suggesting that it was a massive reaction, and in the moment it was fairly large, but it all just seems volatile now. How's your read on that?
Yeah, so that's a good point. So early in the day, we saw the Dow Jones go down about 1%, and the ASX is down a bit today. But this also is concentrated in like specific sectors that I think is important. So, for example, like the banking sector in Australia went down like 3% today, which is obviously would affect them more, the rate decisions. So, I think it is very kind of like generally this moves the whole market, but I think at the moment it's very kind of sector specific. And real estate was also down today as well. So we did see that early significant move down that did shock the markets, and now they're slowly recovering. But I think a lot of it is just like an indecisiveness on what is moving forward. And that's why we saw the initial shock down. And then, oh, wait, we don't really know what's going to happen here because of the Fed's just previous decision making. So let's just kind of, kind of stabilize after that, I guess.
And that's a good point, and brings me to what I'd like to know your opinion on around what the Biden administration in this case can do, what the political implications and ramifications are of this uncertainty, because I'm starting to get a little bit worried. We haven't talked about this recently, but we certainly were earlier about the Fed really maintaining its credibility, for lack of a better word. If it's constantly changing its mind. I mean, the problem with the Fed, of course, is that we've got that dual or multiple mandate where they're trying to achieve multiple objectives at once, only one of which really is inflation. Stability probably trumps inflation. So what's your take generally on the political implications?
Yeah, so I think this is just a very interesting scenario because, as we discussed previously as well, whichever administration is in power, obviously they want to have the economy doing well. And so when data like this comes out, it goes against that, it can be trouble. So the Fed probably has some level of political pressure, even though it's apolitical, right? It would have some political pressure from incumbents to potentially lower rates or make the economy look good again. Now, they could also go the job route, which they do on the jobs report, which is just fudge all the data up. And, then we're all good. We can hide how bad the numbers are, which we've discussed in the past, where they'll show like an unemployment figure and they'll raise it or lower the amount of jobs created, things like that. So they could go that route. But inflation is something that generally they can also kind of play with and manipulate. And the fact that it still went up is very interesting. And I guess one big point I want to make is a lot of the factors that are affecting these inflation reports are outside of political control. I mean, rent prices are skyrocketing, and fuel as well. With the geopolitical tensions, doesn't seem like it's going to go down anytime soon. So the factors that are driving this inflation are difficult for the current administration to handle. And so we might see, some bad numbers on the horizon, and then that could put pressure on the Fed to potentially lower them just off that political pressure.
So how do we frame this in terms of probabilities or expectations around what the Fed does moving forward? Because you've got multiple factors at play. It seems like the market's saying we can't really be sure. And as you pointed out there, the Fed is under a lot of pressure, and they also want to maintain that credibility that they're fighting inflation, but also that you can believe what they're saying, because it wasn't long ago that we were pretty convinced from the words coming out of Jay Powell's mouth that we were getting a rate cut. What happens here? What's the expectation from you?
Yeah, so a couple of things. Firstly, on the actual expectation front, I'll put up a graph of like June rate cut odds, and they basically just went to zero. So,
and that was a pretty sure thing not long ago.
Yeah, and they've gone to zero. In July, Fed rate cuts have also gone down to like 50%. So as far as actual chances and odds of future rate cuts, that's going down, which is bad news. Interesting you bring up Powell. I think it was only a few weeks ago that we were saying like he was basically saying rate cuts are a given. He would the framing of the words and they were saying more than they usually would say or they should be saying, and it was all kind of positive. And now to like have to kind of potentially walk that back is very interesting. But I guess one point I want to make here as well is, we make a point that a lot of this data, is lagging, right?
Yes.
So this inflation data, probably was relevant 6 months ago, and the Fed often makes, to their detriment, has made decisions in the now based on lagging data. So, there's no surprise the Fed's credibility has gone down because they're making these decisions on lagging data when they should be making decisions, based on the current economic environment.
And we've talked about that before, because if you think of something like the housing component or owner's equivalent rent or whatever those aspects are that are definitely included in those, at least some of the CPI figures, those things are very lagging, because you think about that practically as a person. You don't go and adjust all of your rents and everything day by day. People are on contracts. It's a longer term process. So you expect the inflation around those to lag other forms of inflation that can, or prices of goods and services that can quickly change. So it is a real issue part of the argument that I've been making is that the actual, I suppose, infrastructure, you call it, around how they calculate the CPI is very dated. So they're using methods that are not really what you would consider appropriate for a modern world where we can get a lot of this data in real time. So, there are other measures out there that would be more accurately tracking in real time what inflation is actually doing. And they seem to ignore all of that in favor of these highly convoluted and lagging indicators that they use.
Yeah, and I think that gives them obviously probably a different picture than what's going on, and then again in turn ruins their credibility when they make decisions off that. I mean, that's the big thing today is like, are the Fed going to now have to walk back a lot of their comments around rate cuts? And that's not going to look good. And obviously the administration wouldn't want that. They want these rate cuts. But then also, if they were to do a rate cut in June, which is virtually 0%, that would make no sense, because the entire basis of their previous rate decisions would be out of line. Because, a year ago, if this came out, we would raise rates. But now, it doesn't look like we're going to drop them. But yeah, it's Fed's all over the place.
I do have one more sort of question on that or point that I'd just like your opinion on, because I'm starting to think that it's not just about needing the rates to be lower because of the debt burden and the interest that the government has to pay on that debt. Obviously higher rates don't help that situation, but it's also having runway is how I've been terming it, to deal with growth in the future, right? So if you have rates high and they just never come down, we don't get the rate cutting cycle at all, then the next time we're really, or later in this cycle when we're really, running away again and we've got inflation pressures really pushing higher, because at the end of the day, this wasn't, even though people are saying a shock jump and, a massive jump, it really wasn't. If you look at it, it was a small move compared to where we've been, where we were really big moves that were happening. So I think part of the reason they need the rate cuts is just to give them runway for future rate hikes. You can't start hiking if you're already at the top of the last cycle without creating massive problems in the future. What's your take on that?
I think that's a great point, and I think that they've got themselves in a corner here, like you're saying, like they're at the top, and the data that they're usually based decisions off is telling them to, if anything, increase it, but they can't. So, I think it could be a similar situation to when, well, 10 years ago when rates were like extremely low, it was the other way, right? And it couldn't go any lower. And so if we had data that would push us lower, typically push us lower, we might not act on that. So we could see a similar thing where we just stay at this level for a while. But then that's going to hurt, of obviously mortgage holders and lots of people if we stay at these levels of rates. So they've really put themselves into a corner here. I think it's going to be tough to get out without reducing their credibility, because they can get out, they can just keep lowering rates, and then if the lagging data just goes up, it just kind of, I think, it just kind of ruins everything that they've talked about.
No, it's such an interesting discussion, and I really like the way you're looking at it, where you've got the back in a corner angle that really we've seen over the last number of years now. It's really not operating well, is how I'd word it. It's not operating in a free sort of flowing state that is actually adapting to the economy. They're probably trying to overwork it, and that's not necessarily ending or going to end well for anyone, and it hasn't so far, and will certainly not for people on the ground, and we'll see how they go, I suppose.
Yeah, I mean, the outlook is very confusing. I think I wouldn't say it's optimistic or pessimistic. I think it's just, very, very confusing time at the moment.
Well, thank you for all your work on that today and that discussion. I think that's really interesting, and we'll keep watching. It's obviously a big thing that we follow, inflation, so we'll keep watching and seeing how it unfolds. But thanks for your work on that today, Branko. Thanks everyone for watching. We'll chat again soon.